Hi, and welcome to the Stockscores Market Minutes for October 22nd, 2018. In this week's episode, the thing that you should never trade with, plus my regular weekly market analysis and the trade of the week on HP. All right, before we get into this week's analysis and discussion, let's talk about the upcoming events that you can register for on Stockscores.com. Tuesday, October 30th at 6 p.m. Pacific time, I will do a presentation on how to become a successful day trader. And then on that Thursday, how to become a successful investor. Following on the Saturday, November 4th at 10 a.m. Pacific time, the Stockscores training overview. I will show you the different training programs that we have, options that you may want to consider. So to register for any of these free events, go to Stockscores.com, click on Trader Training, Upcoming Events, and then simply register. And once registered, even if you don't attend, we will send you a video follow-up if you are unable to join us. All right, let's get into this week's discussion. Don't trade with this. Some of you may have heard of that part of your brain called the amygdala. It is that part of the brain that processes our emotional memories. An amygdala hijack occurs when there is an emotional arousal that makes us react without the benefit of logic or reason, and that causes us to go into the fight or flight response. It is totally irrational, and it happens often in trading. It causes us to do things that we wouldn't do if we were feeling calm and rational. And so when we face trading stresses, we can go into this mode and make really big mistakes, causing bad trading decisions. And it's important to recognize that feeling. And if you feel the panic coming on, to step away, slow down, and just breathe to let that fight or flight response go away so that you can make a rational decision on what to do next. All right, let's get into this week's analysis, starting with the US markets. And here is the 30-day, 60-minute chart of the SPY. And we've been in pullback mode. And this week we came back from being oversold, rose up to the trend line and got stuck. Exactly what you would expect to have happen. And we've been grinding our way slower. So what you want to watch for short term is if we can hold these areas of support, first of all, and if we can break the pullback trend line on this shorter term chart. If we break the little downward trend line, then you can probably breathe a little sigh of relief if you are a bull. However, until that happens, I want you to be cautious because it shows that the sellers are still in control of this market short term. Moving on to the longer term trend, you will see why this is so important. The long-term trend line on the S&P 500 is still intact, but only barely. It has pulled back to the trend line. It has bounced off of the trend line and held the last 2 weeks. But if we don't hold that short-term pullback that I showed on the last chart, we are at risk of breaking that long-term down or upward trend line, and that could lead to substantially more weakness. So very critical time for stocks. Most likely they do hold this upward trend line. Most likely we break that short-term trend line that I showed earlier. However, if we don't, then we're going to need to be real cautious with stocks near term. On to the Russell 2000, and this stock market, or this section of the market, I guess, has not held that upward trend line. You can see that it has been broken, and that means that at best case scenario, the small cap stocks are destined to go sideways. It may be that we are just going to build a sideways consolidation pattern, this being where we are right now. However, we could also roll over and continue lower and really take value out of those small caps. So we've got some decent support here from the pullback in March. We've got some more support there. And if we can't hold the lows from 2 weeks ago, then I think that's what we're going to start working on, is hitting those areas of support. So a little more caution is warranted with the US small cap stocks. Onto the Canadian markets, and of course the TSX has underperformed the US markets this year, largely because of concerns about trade and that sort of thing. And although oil prices have been strong, the price for Canadian oil a real discount because of transportation problems, lacking pipelines to get the Canadian oil out of Canada, and therefore people just don't want to pay as much for it. Similar story with the short-term chart. We got oversold and we've come back to the trend line and are now basically getting stuck at that downward trend line. So same thing as with the US market, we need to break out through that downward trend line in the short term to return to stability. Now it is encouraging that we have some rising bottoms that are building there. However, if that cycle gets broken of rising bottoms and we then start to test those areas of support from the lows of November 12th, then you need to get worried. So for now, it's potential that we will break that pullback, but until it does, I want you to be cautious with Canadian stocks as well. The longer term chart doesn't have as good of a situation as the US market because we have broken that upward trend line. It's a little different here though because the Canadian market also didn't really have the strength that the US market has had. And so in this case, we're really just stuck in this sideways range. And I would probably draw the pattern more like this, where we're in a sideways ascending triangle pattern with support basically where we're at right now. I wouldn't worry so much about that long-term trend line because we're really in a sideways pattern that's been building for over a year. TSX Venture, more weakness this week. The bounce that we saw, 2.5 months ago hasn't really held. It's not really appropriate to say that, I guess, because we haven't broken down through support yet, but we are looking like we may test that support zone after breaking that downward trend line, but only barely. I think we have some work to do on the TSX Venture stocks. Investors just not that interested in the small cap, micro cap stocks. And of course, the cannabis sector, which was very hot, has quieted a little bit. The news is out, cannabis legal in Canada. What's the next catalyst for energy in that sector? That's what we need to see. And it probably will come in the form of mergers or acquisitions, but I don't know that, until we get some of those announcements coming, that sector is probably going to drift lower. Now on to currencies. US dollar. I decided to show you a daily chart this week, just to show the volatility that we've had the last little while. It's a lot of up and down, not really trending like we had back here. And so we have, good support. We're basically consolidating under resistance, but there's quite a bit of volatility, and that shows that the market is fairly uncertain about the direction of the US dollar. The long-term bias remains up, but short-term, it just can't seem to generate stability and then break from that. And that uncertainty, a bit of a concern because it makes it hard to predict. So I remain bullish on the US dollar, but with a good deal of short-term uncertainty, I think it's hard to trade around it. Now in the Canadian dollar, we have had also a lot of volatility, but the downward trend line was broken. That was step one. And we're now building this very choppy sideways pattern, but with no solid basing going on. It's, chip chop, lots of choppiness. So again, difficult to predict. I don't think it's out of the woods yet, even though it broke the downward trend line there. It's got a lot of chop going on, and that shows investors not really confident. What's key is whether we can hold that support zone to maintain the rising bottoms that are underway. We're getting close to testing that now. So be cautious with the Canadian dollar. It's trying to reverse its weakness, but it has work to do. On to interest rates, which was the concern of the market. It was interesting on Friday, the market actually moved opposite of interest rates. When interest rates started to rise, which normally makes the market go down lately, when the interest rates fell, which would normally be supportive for the stocks, stocks actually fell when that happened. So we're getting a little bit of an inverse relationship. I can't explain it, but it's something I noticed on Friday. The bias here on this chart remains in a downward trend, which means an upward trend for interest rates. And until that trend line is broken, I would be bearish of bonds, and therefore the likelihood that interest rates rise is there. But until we break that support zone near term, it wouldn't get, we won't get to the next leg of interest rate rises, but something to keep an eye on. And on to commodities. Gold, of course, broke its downward trend line last week, or I guess the previous week. Last week's episode of the Market Minutes was there. We were pretty stable, didn't give back a lot of those gains. That's encouraging. I think really gold is just a hedge against the market uncertainty. If the market can hold its upward trend line and stabilize, I think gold is going to roll over. But if we get a further correction, if we break down through those support zones that I showed you on the S&P 500, then I think gold rallies. So something to trade right now. I would be a pretty short-term trader, short-term mindset with gold right now, because the long-term picture isn't good, but that volatility is encouraging if you are a short-term trader. Now, oil has seen some weakness the last couple of weeks, and that's something that we predicted here when oil was quite overbought on the top of that channel, and we're now pulling back to the bottom of the channel where oil prices should bounce. We could go down a little more. I didn't draw that line exactly perfect, but we could go down a little bit more and still hold the upward trend line. I think oil bounces back in the next week, perhaps, and so you want to look for opportunities to play some bounces in the oil market. Of course, the risk is that we don't hold the upward trend line, that we instead break it. But until then, what is most probable to happen when prices pull back to trend lines of support is they typically bounce. And so that's how I would play oil near term. So my ratings then, neutral long-term on US stocks, bearish short-term until we can break that pullback. I would remain bearish there. And same story for the Canadian market. Gold, neutral long-term, bullish short-term. It's been holding the gains of the last week and a half quite well. Oil, bullish long-term, neutral short-term. It needs to hold that upward trend line. So stocks have stabilized this week, and they're holding that long-term upward trend line of support. This means that they're really at a critical point, because if the next wave of price movement is down, we're going to break that long-term upward trend line. If the next wave of price movement is up, then we hold the upward trend line and remain healthy. And that's really the thing you want to watch for. Now, oil is at a similar kind of a situation in that it is pulled back to its trend line of support. I would say it's most likely to bounce, but until it does, you want to be selective. But a good trading opportunity comes in actually trying to pick that bounce point. Gold is holding its recent gains, but it still has work to do as it hasn't had the next wave of buying come into it. All right, this week's trade of the week is a loser, stock that I traded on Thursday. And I want to emphasize a couple points with this one. So first of all, let me show you the trade. I entered it short there, traded heavy volume, gap down through support. My day trading strategy would take that as a short, and I did take that as a short. And in the case of this stock, I put a stop at basically right about there, -3 RR, and I got stopped out right here. Now, what then happened is the market sold off, and my short ended up being profitable by the end of the day. Not extremely profitable, but profitable. And so it would be easy to say, well, maybe you shouldn't use stops. Maybe you should have just waited, been more patient. Don't take the loss. And in this case, that is what was more effective. However, having traded lots of times, I will tell you that you have to manage risk effectively. And just because on this trade, taking the stop didn't work, that doesn't mean it is the right thing to do. I have data that shows that the right thing to do over thousands of trades is when you hit that price zone, it's best just to take the loss and move on. In this case, it didn't work. I took a loss. I wouldn't have had to take a loss if I had held all day, but that's trading. And I want to emphasize that trading is not about what happens on one trade. It's about what happens on many trades on a large data sample. Well, that has been the Stockscores Market Minutes. Reminder of those upcoming events. Go to the Stockscores website to register. Please subscribe to the channel. And if you like this video, click on the like button. If you have a comment, please post it as well. I always read them. Have a great week in the market and trade well.